I'm Alan Siegert of Navitar, and I'm excited. We've got a great panel. With us today are 4 leaders of prominent middle-market M&A companies. And along with me as co-moderator and representing private equity is one of my favorite GPs. We're going to be talking about deal sourcing trends. And hey, we've got some interesting new numbers about deal sourcing from a highly respected source, our number-crunching friends at Sutton Place. We'll talk about best practices during auctions and how technology is changing deal sourcing. And speaking of technology, a brief word about Navitar. We are the connected growth platform that supports M&A, private equity, strategics, and placement agents, along with a deal network and an investor portal. 600 clients in 35 countries. We're coming to you today from our headquarters in New York. So let's kick this off by introducing the panel, starting with our co-moderator, Martin Stein, who is in beautiful Grand Rapids, Michigan. Hello, Martin. What should the audience know about you and Blackford?
Thanks, Alan. Great to be here. I'm Martin Stein, the founder and managing director of Blackford Capital. We're a 15-year-old private equity firm focused on the lower middle market. We do exclusively majority-controlled buyouts of family-owned industrial businesses. We look at companies with 20 to 100 million in revenue, 2 to 10 million dollar in EBITDA, typically 10 to 75 million dollars in transaction value, and we are focused on exponential growth. We've been fortunate to be awarded the Deal of the Year for the last 3 years in Michigan, and M&A Advisor awarded Blackford Capital the Deal of the Year for the entire U.S. last year.
That's great, Martin. Next, let's hear from Bruce Cameron, who is the CEO of Berkshire Capital here in New York. Good morning, Bruce.
Good morning, Alan. Thanks very much. My name is Bruce Cameron. I'm the president and CEO of Berkshire Capital. We are a 30-year-plus old investment banking boutique with offices in New York, Denver, San Francisco, London, and Sydney. And our focus is on financial services, M&A, and advisory, particularly in the asset management securities area. We have about 40 people. And we think part of what we bring to the table is a global reach with our long history and transactions that have tended to stick. We take a great deal of pride in putting together transactions that have worked over the long term. We've worked as principal early in my career when I was at PaineWebber, and we've created and executed on 2 SPACs. But mostly in terms of executing transactions, we've done over 300 transactions in our sector.
Thanks, Bruce. Our next panelist is coming to us from Hamburg, Germany, Ulrich Schneider. He's a partner at Preventus. Hello, Ulrich, and good afternoon.
Thanks, Alan. Yes, good morning to everybody overseas. Good afternoon to everybody who might be joining in from Europe. My name is Ulrich Schneider. I'm a partner at Preventus Partners. We are a European M&A advisory boutique. We have offices in Hamburg, in Munich, as well as in Zurich. We have a team of about 30 employees, and we focus on mid-market mergers, acquisitions, divestitures, and corporate finance projects. Our typical transaction value is between 10 and 200 million euros. We have a sweet spot somewhere between 20 and 60 million euros. About 60 to 70% of all our transactions are cross-border in nature, and we deal both with leading private equity firms, mostly from Europe, but also overseas, as well as large corporates, as well as family-owned businesses. And I think,
thanks, Ulrich. Back in New York, we're joined by Timothy Page, who is managing partner of Whitehall & Company. Welcome to the webinar, Tim.
Thanks, Alan. So I am Tim Page. I'm a founding partner and managing partner at Whitehall. I've been an investment banker for over 20 years. I'm currently in charge of the capital markets side of Whitehall's business. Whitehall is an investment bank located in Midtown, New York. We specialize in M&A, advisory, debt placement, and equity placement. We're best known for our expertise in the project finance sector, and within that, the energy markets. In the past 24 months, we placed about $6 billion in private securities in the debt and equity markets.
Thanks a lot, Tim. And finally, we've got David Mahmood with us from Dallas, where he is chairman of Allegiance Capital. David, thanks so much for joining us today.
Thank you, Alan. I'm chairman and founder of Allegiance Capital Corporation, serial entrepreneur. This is the 8th company I've started from scratch. Allegiance Capital is 18 years old, headquartered in Dallas with offices in New York, Chicago, Minneapolis, and Monterrey, Mexico. We bill ourselves as a marketing company that does investment banking. We have a very strong marketing capability, not only in generating deal flow, but also you need to be a good marketeer to bring a company to market today and sell it successfully. We are involved primarily, our core competency is the sale of privately held and closely held companies. We also provide financing for these companies and growth opportunities by providing them with acquisitions. Our sweet spot are companies that have adjusted EBITDAs of $5 million to $50 million. We have a proprietary database of 130,000 names throughout North America that we consistently contact about 4 times a year, never knowing when they're going to have that significant emotional event and decide to sell.
All right, great. Thanks, David. So let's get started. Let's start with trends and some new data from Sutton Place. This is what we'll be talking about today, as we mentioned before, and trends being the first thing. Looking at more than 10 million deals on the last year in the U.S. and Canada, it looks like M&A firms were involved in 65% of them. The larger the deal, the more likely M&A is involved. Tim, is that number higher or lower than you expected, and why?
I guess I would have to say that it's lower than I would expect. I would expect that number to actually be a bit higher, and I think the trend would be that it would increase in the coming years. Part of the reason why I say that is because I see the world as becoming more and more specialized in our functions, and investors have less and less time to go out and to originate deal flow because they're doing what they should be doing, which is what they're best at, and that is deal analysis and due diligence. What we see is investors do appreciate an intermediary being involved to help save them the legwork of actually going out and do that origination, as well as providing an initial screen of the transaction so that it can be presented to them in the way that is most appealing to the investors. So I'm actually surprised that the number's not higher, and I would expect in the coming years that to increase over time.
Martin, what's your sense of it? Are the numbers surprising to you?
Yeah, I think as you had referenced, and I think on the next slide, Alan, maybe you'll be getting to that, but it increases, over, as the size of the deals increase, the percentage of the percentage of transactions that have an intermediary increase. To me, that does seem very accurate. And if you were to go down and data doesn't exist on it below $10 million, my suspicion would be there would be even fewer intermediaries that would be involved. And I guess consistently with Tim, I do think there are a lot of trends that could drive that number up, in the future. I wonder, and it'll be interesting to hear, the perspective of, the other panelists about a lot of the trends that, could cause that number to decrease. I think specialization is very critical. I also think it's a lot easier now for, buyers, to find sellers, and vice versa. For sellers to find buyers with the technology that exists, internet, particularly when you're involved with a particular platform company going out and finding additional add-ons within the space. There's a lot more ability to do that today than there used to be 15 or 25 years ago.
This is Dave Mahmood from Dallas. One of the things that we've noticed is many of the privately held and closely held companies we deal with, while the owners know their business rather thoroughly and their marketplace, there's a certain lack of sophistication. And recently, as much as 20% of our business has been with firms that have gone through a process and it has failed. And they've suffered from deal fatigue, and it took a while for them to decide whether or not they wanted to bring their company back to the market. So they're looking for help many times. While I agree it's easier for buyers and sellers to connect, we've also found several private equity groups who appreciate having a good banker on the other side of the table that can help move the transaction forward, since for many privately held company owners, it's rather an emotional event to be able to help manage the process and bring the transaction to a successful conclusion. So I think that the typical middle market, lower middle market banker many times adds significant value and really helps assure that a transaction is brought to a successful conclusion.
So we've established that the vast majority of deals are in the hands of intermediaries, and that's got to raise some eyebrows at private equity firms. Ulrich, let me ask you, what should these private equity firms be doing to make sure that they're not missing out on deals?
Well, we believe that the M&A situations that we deal with, and probably other advisors as well, are fairly unique in terms of corporate situation, the requirements of owners management, the deal situation, the buyer universe, and therefore for us it's very important to get to know the potential buyers as well as possible. The scope of work, their mindset in terms of structuring a transaction, how aggressive or conservative they are, and therefore the best a potential buyer can do is to be in exchange with us, for us to get to know them better, to share our understanding with our colleagues, and not just to know that they are there, but to basically know who would be a good fit for a client, and so they come to the top of mind when we have a project.
Ulrich, it's Martin. Question on that from the vantage point of a buyer. We spend a lot of time each year going to conferences, doing outbound phone calls for, with various investment banks, and even taking visits to different geographies. And yet, despite those efforts, for us, even when we get into an auction process with a successful intermediary, we'll undertake that, but a lot of times it just comes down to price. I guess I'm curious, right? If you sort of knew us and familiar with us, or any private equity firm out there for that matter, how much do those things really matter versus just the price? Because most sellers are going to say, hey, we want top dollar for our company.
Yeah, well, I think it depends on the situation of the seller. I think the higher you go in the transaction value, and the more professional it is, and the more unpersonal it gets, I think price plays a much more significant role. If you move down in the transaction value, I think other items as the structure, the personal fit, the future prospects of their company, especially if it's a owner-managed company that the founder may still be in charge of, then these, I would call them soft factors, can come into are much more prominent and more important. And so it's for us, it's not just good to know who's there and what sector they are in, but to know to have a face in front of you, know their personality, especially in the lower end of the market. But in the end, I think just to be able to identify potential investors is crucial. And from my point of view, I think the exchange between Europe and the US is much more difficult, even despite the fact that the professionalism of investors in the US is usually much higher than in Europe.
Martin, this is Dave Mahmood. If I could respond, I think that it's the investment banker's responsibility in sitting down with a seller to explain to them that while they approach the sale of their company as getting the best possible price as being the paramount goal, we spend a great deal of time explaining to them that they are going to stay into the deal, generally speaking, as a minority shareholder, that they don't want to make the next several years of their life miserable, and they better make certain that there's what I call a shared sense of values with the acquirer. And so we believe we have a responsibility to psychologically set up the seller for what's going to take place and what's going to happen. You know, every intermediary certainly wants to sell the business and collect a commission. On the other hand, you want the transaction to be successful long term, both for the buyer and the seller. And there's been enough private equity deals that have taken place where unhappy owners have exited the company and the relationship part didn't work out very well. So we spend a great deal of time. In fact, we bring the potential sellers into our offices from around the country as our guests and spend a day educating them, sharing with them what they're going to experience in a typical transaction with a private equity group and what to expect. It makes the transaction go a whole lot better. And, you know, the old cliche, forewarned is forearmed.
Okay. Let's continue talking about auctions for a minute. Bruce, you focus on financial firms in the financial sector. Let me ask you what factors from your perspective other than price should private equity firms be thinking about to help win deals during the bidding process?
You know, there are a couple of things that we think are fundamental in terms of the private equity firms that are successful in the transactions with which we deal. Certainly a part of it is industry knowledge. It's frustrating to a lot of the people with whom we deal to be trying to educate people about their industry. So it tends to be that people who specialize in financial services have better luck. Having relationships, and this goes a little bit to some of the things people can do, is important. And so showing up sort of cold where they've never met any of the people in the firms before makes it a lot harder because as we were talking about before, a lot of this is about the ongoing sort of relationship. When people sell in financial services firms, typically they're going to stay there and work for a number of years going forward. So the relationship and the working environment is pretty important to them. And then it's the attention to detail, it's the responsiveness in the process that are very fundamental in terms of keeping people happy. We've been going through one situation recently where there are a couple of private equity players involved, and one spent the time to understand the background on the people. They were, made an effort to get to visit with them right away, have followed up on a regular basis in terms of staying in touch, sending them articles about things that relate to their business. We have another one where it's been tough to get, a meeting with them. We set up a conference call with them, and the senior guy suddenly couldn't be on. It's stuff like that, showing respect for these businesses that are fundamental. And then to developing a real relationship. The economics are important, but the relationships and the ongoing sort of interaction are probably more important in a lot of these cases.
Bruce, it's Martin. The comments that you made, I guess, seem like basic etiquette. I mean, are those really differentiators for private equity firms? How many private equity firms are you finding that don't have attention to detail, are not responsive, don't show respect to buyers or to sellers?
You'd be amazed. They're all very busy, and it's not intentional necessarily, but a lot of them have a lot of different transactions going on, and so getting their attention, getting them to sort of follow up is difficult. Another thing we see is that they'll often have someone junior reach out and start to develop the relationship. And if someone's gotten in and developed a relationship with someone at one of these firms, leave them involved. What we occasionally see are the senior guys then do show up, but they take the junior person out who's developed a relationship, and they don't seem to get the importance of that. So you're right, it's a lot of sort of common etiquette, but it's amazing in this world where people are so busy and so pressed that they don't pay attention to those things.
Sounds like a recommendation would be that people should read Emily Post.
That would work.
Okay, David, let's take a look at the other side of things. In your experience, what kind of things beyond what Bruce has mentioned have you seen private equity firms doing that have actually hurt their chances of winning a deal?
Well, some years ago at an ACG Intergrowth conference, I spoke with the managing director of a fairly large private equity group who indicated to me that, David, we look at 100 firms in the course of a year. We issue 25 LOIs, and we follow through on 4 to 5 of them, which we end up buying. Which said to me, and I don't think he realized it, that there were 20 or 21 firms that had their clients sign letters of intent that never went anyplace. So I think that private equity groups many times hurt themselves by moving too quickly. They don't know that much about the company. They haven't even met the owners and management, and they're already talking deals with a desire to blitz a deal and move in real quickly and, avoid the auction process. I appreciate that, but we're very careful. We want to make certain that the chemistry is right, the price is right, that the private equity group has made a big enough investment in time and effort, so we, increase the chances of closure. Too often, we've seen private equity groups move quickly and then, step back and say, oh no, this really isn't for us. We've taken the company off the market. So many times in a rush, the private equity group will do themselves a disservice. More confidence with firms that we work with over the years that take the time to build a relationship with the client, and we're careful. We don't go to private equity groups who don't understand the vertical, have no background or experience. We look for people who either own companies or presently have companies in the vertical, so it's not a matter of trying to educate them or they're going outside, hiring outside experts to tell them whether or not it's a good deal. It's easy to get mesmerized by a $80 million company that's making $20 million. In fact, I have one right now that has almost a 50% gross margin. Highly attractive, but a lot of people would make an offer on it. But we're going to limit it to folks who know and understand the business and appreciate why the company is making that type of margin.
Hey, Alan, this is Martin, the lone private equity guy on this amongst the panelists. It's hard to be a PE guy on this call with a lot of these comments here.
Are you worried about getting blacklisted? It sounds like they're kind of choosy about who they go with.
Well, I think that David's comments and Bruce's recent statements are really insightful, and I think gets at sort of the heart of what this call is about. David, loved your numbers, in terms of the challenge, right, for a private equity guy and the number of, deals that come through. I guess I'd sort of put it back out there to any panelists, any of the other panelists on the investment banking side, because I know when, we're looking to exit a business, and certainly when we're looking, to buy them, a lot of the investment bankers will say, hey, we go out to the top, 300 private equity firms. On top of that, we'll do anywhere from 300 to, some investment banks say there are 3,000 to 5,000 prospective buyers. And so, I think one of the trends for today's market is that there are more companies that are coming to market to a much broader group of buyers. And so our difficulty as a PE firm is exactly that. I mean, we'll get 5,000 transactions a year, knowing that there are 1,500 to 2,000 that'll close a year, and also knowing that multiples have expanded quite a bit. So I guess sort of given that environment, right? We've talked about what private equity firms can do, but I mean, how else is it that you can manage without sort of quickly moving in, off of transactions, onto one that you think could be a good fit or better? But just an extremely challenging market with so many companies coming to sale, and so many investment bankers taking them to a wide universe of buyers.
Anyone want to jump in on that?
Well, this is David. I have an appreciation for what Martin has just stated. I've been in this business for 30 years now, and we belong to an organization called Global Scope. They got 60 offices worldwide, over 500 investment bankers. We send deals back and forth. So we live in a global world. We're doing cross-border transactions on companies that are making $5-6 million EBITDA. Years ago, that was something that never took place. The net result is that a guy like Martin ends up drinking from a fire hose many times, and it is tough. For us, we recognize a number of private equity firms out there. We try and discriminate rather than just sending out broadsides. We really try and determine what's in it for the acquirer. So we look for private equity groups that have a track record of either having owned a company or presently own a company in the vertical that can potentially relate to the business and to the client. And so part of the problem is too many investment bankers send out a profile to everybody in the world. My attitude is you should have an appreciation for the buy side in the sense, what's in it for them? We spend a great deal of time doing research on buyers. If we're going to go to a buyer and say we have a transaction, we should be able to explain to that private equity group that based on what we see, and we try and give them a good enough explanation, it is more than just sending out a sheet on the company. We make a point of going and calling, talking to the potential acquirer, laying out for the private equity group what the business is about. We appreciate a quick no, no, this really isn't for us. We find that extra work pays off because if you give the private equity group a real thorough explanation on the company, the vertical, and you tell them why you're calling them because they presently have a company in their portfolio or have had one in the past, they can respond more intelligently than they can from just a sheet of paper that gives them the industry, the revenue, and adjusted EBITDA.
So that kind of leads into technology, and some people say that the current technology is disruptive. I see it, of course I'm biased, with Navitar as disruptive in a positive way, helping both M&A firms and private equity firms do more deals than ever before. But I was wondering from the panel in general, and maybe Martin wants to address this specifically, how you see technology changing the M&A business and the private equity business, and how you interact with both on the buy side and the sell side.
Well, Alan, good question, and a number of these themes have sort of already come up over the course of our conversation here. In the old days, we did look at, as David said, 100, up to 500 deals a year. Today, we're looking at anywhere from a light year for us would be 4,000, a heavy year would be 6,000 deals that come up a year. And it's impossible to be able to do a deep dive and, get down into that many transactions. It would not be economical either. So, we have to do a very, very quick screen. And as I think it was, Bruce, had referenced, it's tough to do that, and it's hard to be, necessarily as responsive as we would like. If there were some sort of, unwritten rule that investment bankers would only take it to 300 and the best 300 buyers, or to 50 buyers, even better. Then I think we'd have more of an opportunity to do those detailed reviews. So the number one impact that I see of technology is increasing the speed and the processing that we have to do of the individual transactions. The disappointing part is that it also creates a much more challenging environment to build that relationship. That David and Tim, had talked about in terms of how important it is for the buyer and the seller to have a fit. So I'm a little bit pessimistic on that with technology. With that said, there's no way we could get by and survive in the world today without a tool like Navitar. It's been instrumental in helping us review those transactions. There are just costs associated with it on the downside.
This is Bruce. I have probably a very different perspective on all this. We use the technology, in effect, to do a huge amount of the pre-screening, and it sounds like most other people are going out to huge lists of players, and maybe that's the orientation in other sectors. In ours, our clients look for us to do the screening and to go to as few people as possible while still creating a competitive arrangement. So we are much more frequently going to 5, 10, maybe 15 people. And the way we make sure we're going to the right ones is we do a lot of talking to people, around the year among our 15 partners, and we collaborate and put that information into our CRM system so that we're all up to speed on what's going on, what sort of information we've gotten from those various conversations. And that allows us to think about what are the right set of people to go to for our clients. Our clients are incredibly sensitive about confidentiality. Letting the information get into the marketplace is, if not death, it's certainly damage to their business. So we're trying to keep it as small as possible and use the technology to allow us to pre-screen people and focus just on the ones that we think are really the best fit.
Bruce, this is Martin. Do you still think you're able to get the multiples at premium level for your sellers as a result of that?
We have, if you look at the transactions in our sector, yes, the transactions we do are consistently at the sort of premier types of multiples. But, as I'd indicated before, part of it for our people is the valuation over the longer term, since they're often selling a partial interest. And if they get an attractive multiple up front and get someone that can really help them build the business, and I said one of the things we also look for is continuity and people staying with the business as part of our measure of success, then the long term is that they may get a good price up front and an even better growth and valuation over the long term. So it's a lot of things you have to look at. But yes, I think our clients have historically been very happy with the valuations.
Makes a lot of sense.
Ulrich, your comments on this? Do you want to jump in?
Yes, I would. I'm in a similar situation as Bruce said. I mean, we usually deal with privately held companies who are very sensitive on a lot of issues like confidentiality, like a good fit, so they rely on us on doing a lot of screening beforehand and finding the right partners. I think that also adds to deal closing security to find a great fit. And for us, it's therefore very important to do good screening and to have the relevant information on the potential buyers at our fingertips and have the data points, but also I would say additional information on portfolios, on deals at hand. And therefore, I think technology is very useful for that because it provides a lot of information to you, something that you didn't have before. But in the end, I think it's for us, it's very, very important to have the right information on potential bidders rather than spreading it out.
So we're going to get to. Go ahead, please.
Sorry. I would just say, we kind of do the same thing. This is Tim Page, by the way, from Whitehall, and for us, we kind of look at each process as a bespoke process and kind of figure out what is the best distribution plan for each security, and it really depends on the situation. So, for example, if you have a very plain vanilla product, maybe you have an investment grade bond that you're going to, maybe that's say $150 or $200 million investment grade bond that you're going to bring to market. Well, that's going to be very appealing to a very wide, very broad variety of clients, and to get the best execution in that type of a market, it does require a broad distribution. So yeah, you're probably going to your favorite, 1 or 200 friends to get that process completed in the best, most efficient manner for your client to drive that pricing to the best market pricing. On the other hand, a lot of our transactions are very bespoke and very unique, and they could even be maybe a large transaction that you go to a small number of folks. Earlier this year, we did a deal. It was around a $520 million equity transaction, a placement for a unique power plant asset. We used the Navatar product to look at our past 4 or 5 deals that we did. We culled down a list of our, kind of 200 favorite friends to a list of 20 likely buyers, and we only went to market to those 20 potential buyers because they were really the ultimate guys who were going to be serious about this. So we didn't want to waste our time or the client's time or any of the investors' time to look at a process. It didn't make sense to go out to anybody else other than those. We selected 5 of those investors and brought them through the second round of the process and had a successful deal. But it very much depends on the type of the asset, the type of the product, and your mode of distribution. I think as investment bankers, we need to spend. It's incumbent upon us to spend a little bit of time at the outset of the transaction to really decide who are the appropriate buyers, who is the best type of buyer for my client, and spend a lot of time ahead of time, and it's going to save you more time later to do that up front to really drill down to that best buyer most quickly.
Well, this is Martin here, and I guess the risk of being controversial here. Maybe that's not a risk. Maybe that's the point. So it seems a significant assertion to hear. The number of panelists who say, we can find those right, 15 to 30 buyers, out there. And I think in niche industries, that may be the case. And particularly, and it also may be the case as you start to get to, larger and larger companies, above, $500 million. There are probably, in niche industries, the number of prospective buyers decreases. But we talk with hundreds of investment bankers, a year, as you talk with hundreds of buyers, a year. And I know one of the themes that comes up frequently is that a lot of times sellers will not know who the ultimate, buyer is going to be. There's one particular investment bank that does tout the large, scope and reach that they've got, and from their data, they assert that 75% of sellers did not know who the buyer was, who the ultimate buyer was going to be at the start of the process. So I guess it's just I'd love to hear some commentary on that. How it is that you were able to find, the 15 to 30. Buyers and that you can still maintain, the sort of maximum, selling price in that when you've now got a global marketplace. And as David had said early on, $5 million EBITDA companies are now being sought after by international acquirers.
This is Bruce. And one of the things that we do with people is we may start out with a broader list that we go through with our client if we're representing a seller. And talk about some of the potential targets that are out there. But what we try to do is, with the information that we have about the marketplace, go through the list and discuss some of the cultural and other sorts of aspects of different firms, and the clients help to narrow that list. So it's not that we just come in and say, oh, here's the 15 we're going to show you. We're not going to mention the other 30 or 40. But by going back and forth with them, sort of privately in their offices, talking through the aspects of the firm and discussing the sort of approach they take to transaction structures, the approach they take to integration, the approach they take to working with people, the sort of valuation parameters they typically have, you can narrow it to a group of people that are more likely to fit. And since they have to spend time with each of them in terms of meetings, it's not just looking at numbers. There's only so much time in the day, but they're still running their business. And they usually like to keep it that way. But our business may be unusual in that sense.
Alan, I know we want to open it up to the sort of broader group. I'm curious, Bruce, what portion of transactions that you do are international, A, and then B, also have buyers from an external or neighboring industry that end up being the acquirer?
The amount that's international at this point is probably somewhere between 40 and 45% of the total, so it's quite a bit.
Yep.
The amount of people that come in from neighboring industries has actually declined over the years. It used to be that we'd see, industrial companies trying to buy asset management firms or securities firms. You'd see banks and insurance companies going across the lines. Now there's, within the financial services, there's probably a fair amount of cross-roughing in terms of that, but you don't see a lot of people from other sectors because of the regulatory issues that have, arisen and make it much more difficult.
So we're going to start taking some audience questions from the GoToWebinar control panel on the right side of your screen. The audience is muted because we want to avoid feedback and extraneous noise, in case some people had asked about that. So Ulrich, Bruce, Tim, David, and of course Martin are interested in your questions, so don't hesitate to enter them. We've got a first one coming in from Jessica, who I believe is at a PE firm, and wants to know the best way to get in front of an M&A firm so they don't miss deals. And I guess she's referring to making calls or sending emails. Let me throw it out to the group. What is the best way to approach you if there's a PE firm that's not on your radar?
This is David. For us, we really appreciate private equity groups that can be more specific as to what their interest is. Too often, PE firms all sound alike in that they're looking for things in certain verticals, areas that they indicate they have interest in. Those private equity firms that take the time to really share with us their sweet spots, so to speak, those areas they have particular experience and interest in and can talk about intelligently. We put that in our database. That is a big help when we have a company that we believe is a good fit for what they're looking for. An awful lot of firms, we're spending time looking at what they own or what they have owned to try and determine whether or not what we have would be a fit and why.
Tim, do you want to jump in on this? Or Chris, go ahead. Go ahead. Bruce.
It's Bruce. I was going to say, just making the effort to sort of get in touch with us. We have people that send us emails as introductions, and then a follow-up call or a meeting to understand exactly, what their interest is in the sector is helpful, just so that we get a sense of who they are, because having a sense of the cultural fit is important from our perspective. So we need to actually talk to them to ever involve them in a process.
I agree with that. I mean, we do probably a couple calls a week with investors, new investors, potential investors that may have seen one of our transactions that hit the wire, want to learn a little bit more about that, but also want to, describe to us their preference and criteria for investment so that we can be on the lookout for them. And I think with any of this, communication is key. So it goes both ways. We want to learn about you, and we want you to know about us and the transactions that we're bringing to market as well, so you can be on the lookout for our deals.
This is all right. I think it's always very helpful to understand some experience. To private equity investors, I would suggest to them, talk about the deals that they did, what was special about them, how they succeeded, because it adds some flesh to the bone rather than just the verticals and the deal size that they're interested in, but actual deals that they worked on, they were successful on. I think that always gives additional dimension.
This question's for Martin. Fraser asks if LPs are bringing up deal sourcing capabilities during fundraising conversations.
Yes, a lot. Very interested in, our understanding on the market, what's transpiring, multiples going up, down, structure, increasing, decreasing, how we go about finding our deals. And a lot of the LPs are interested in and intrigued by, proprietary sourcing. It's interesting with the data right from Sutton Place, how little proprietary, sourcing is actually going on. I think a lot of private equity firms try to distinguish themselves, with that. But LPs are highly interested, right? We've got to find companies, we've got to buy them, we've got to govern and manage them, and support them well, and then we've got to sell them. So the LPs are interested in each facet of that and what it is that we do that's different or better than the other GPs out there.
We have a comment from Steve. Where do the buy-side research firms fit into this whole process? Martin, do you make use of a firm doing buy-side research? And I'm just curious how the others view these firms and their role.
Well, I guess would want to clarify on the buy-side research. There's sort of buy-side representatives that are selling businesses and doing that. We certainly look at a lot of those. It's a very different process than the constituency that we've got here, where you'll have a broad blast. And I do find it intriguing that the buy-side. There's still a lot of work that is being done, on that front today, given the technology. Right, there are buyer-seller networks out there like Navitar's, Deal Connect. I think those still represent a small percentage of the of the transactions, but for sellers that want to go and sell their business, a lot of them, particularly the more sophisticated ones, will use an investment banker. So as this percentage of intermediated deals increases, it does seem like the buy side will be less and less relevant. With that said, there are still some very, very active firms out there, and I would say probably for us, I don't have the exact numbers, but 15% of our transactions that we've done are represented by a buy side intermediary.
Any thoughts from anyone else on this?
This is David. We recently represented a private equity group where we sold them a company in what I will call a niche business. Their goal was to naturally build the company. In 3.5 years, we represented them in acquiring 9 more companies. And we grew the business from $4 million EBITDA to over $100 million EBITDA. So, from the banker's perspective, it's a little bit like Sunday afternoon football. Some days you're on offense, other days you're on defense. So I think that good investment banking firms have to have an appreciation for both the buyer's needs and the seller's needs. And as an investment banker, the older I get, the simpler it becomes. You know, for the acquirer, it's always too much money. For the buyer, it's never enough. And so personal relationships end up becoming exceedingly important. And we've had several sellers lately take deals that were less than the highest offer simply because of the personal relationship factor. They felt more comfortable with the folks. And so we find that good communication skills, use the word empathy, if you will, relationship building, in this world of thousands of sellers and thousands of acquirers, it's still a pretty much personal business, and that is maybe in the face of all the technology and all the information out there that's accessible today, is what's going to keep us working for a while, because the relationship side is still key. People do not sell their business to people they don't like, so personal relationships are very important.
David, this is Martin. With all of your comments on relationships and the emotional aspect and the empathy and the personal connection, it seems like maybe sellers should hire therapists as opposed to investment bankers.
Well, we send all of our investment bankers through social styles. You know, it's more than negotiating skills. A lot of the bankers we hire are bright, smart, competent, capable, and have a great financial background. And we share with them that a degree in psychology wouldn't hurt. So every year we go through a lot of training. Some people might call touchy-feely, but on how to build trust, nonverbal communications, a variety of social styles training. And we found that our productivity went up because of it. So for us, the results have kind of spoken for themselves. It is still a personal relationship business. If it was only about numbers, all you'd have to do is post them, and the deal would take care of itself. And anyone who has dealt with emotional sellers has an appreciation for what it takes to get a deal done.
Wow, Emily Post, Sigmund Freud, and Dale Carnegie.
Really quite simple.
We have a question just came in from someone that doesn't want to be mentioned. As a private equity firm, we get mad when we are ignored on a deal that we would have been appropriate for. How do we approach the M&A firm involved to make sure it doesn't happen again without sounding whiny?
This is Bruce. You know, we have people that have spoken to us who are frustrated they weren't in processes that went on. And so it's usually we find constructive for them to reach out and ask about the transaction and why they weren't included, and see whether there's something that we didn't know about them or vice versa. Sometimes it's that the client was very particular about the sort of firms that were involved. Sometimes they didn't want private equity, but the fact that they reach out reminds us that they remain very focused on the sector. So it's just sort of reaching out and sort of asking about it, I think, is a fair thing to do.
And kind of a follow-up to this, Anurag asks, who's easier to deal with, strategic buyers or private equity firms, do you find? I throw that open to the group.
This is Martin, private equity.
This is David. If you look at the first quarter of this year worldwide, 80% of all transactions were strategic. Strategic acquirers, like private equity groups, are sitting on a god-awful lot of money. And the reality is they typically don't need banks, they don't need financing, so they do have a built-in opportunity when the market is good to move fast, to move quickly. But again, that only counts for price. It works well where people are willing to sell out 100% and pass the baton, or at a point where they are not interested in sticking around. With a lot of baby boomers today who'd like to take some chips off the table, I think private equity groups have a leg up, because I'm an old guy. I'm 78 years old. I've been doing this for a long time, and I've seen the generational changes that have taken place. And the bulk of our clients today are baby boomers. They're looking at selling earlier, taking chips off the table, but certainly not ready to retire. And that gives private equity a real advantage over the strategics who, want to own 100%, take over. And I think that's a opportunity for private equity groups. I just read an article, though, that indicates there are 4,600 boutique investment banking firms in the United States, and the author was predicting that when we go through the next recession, which unfortunately may be around the corner, that since so many of them are 2-3-man shops, in some cases 5, 6, 7, that the number of investment banking firms, boutique investment banking firms, is going to go back down to 3,000. So I guess we're in a world of constant change.
Well, thanks, David. It looks like we're just about out of time, so we should wrap this up on that note. I want to thank everyone for joining today and for the great questions. Special thanks to our panel, David Mahmood of Allegiance, Bruce Cameron of Berkshire Securities, Tim Page of Whitehall, and Ulrich Schneider of Preventus. And a special thank you to co-moderator Martin Stein of Blackford Capital. At Navitar, thanks to Nicholas Donato, who worked hard on this webinar, and with Sutton Place on the research that we used. And a big thank you to Sutton Place for their help. And finally, a big thank you for pulling all this together, including the scheduling, to our marketing director, Cindy Chow. I'm Alan Siegert of Navitar. Let me know if you have any questions about Navitar or our services for alternative assets. More than happy to help. And we hope you all have a great day.